Chapter 3, Journals. Key points in this chapter. A journal is the list of debits and credits resulting from a financial transaction to be entered into the general ledger. The total of debits will be equal to the total of credits for each journal. So because all the money left over from assets after paying off liabilities goes to the shareholders, the accounting equation is assets equals liabilities plus capital. And so we have all of our money in items on this side, and we have all of our money out items on the other side. As a result, all financial transactions must have two equal sides. The plus money in, the debits going into the company, and the minus money out, the credits going out of the company, and they will always equal each other. If a company makes a profit, whilst it might now have an increase in its assets compared to its liabilities, so a profit is that we get more in terms of more assets in compared to the amount we spent for that money. So although we might have more money in compared to the cost that it has, so our assets now have increased compared to our liabilities, the shareholder will want that profit. So there's an increase in the capital money out item that represents the difference. If the company makes a loss, whilst there'll be an increase in the liabilities compared to the assets, the difference is less money to go out to shareholders in the future, reducing the capital money out item by the difference. The two sides of any transaction are put into our accounts, posted in journals, entries to the company's ledgers, and entries to the company's general ledger. The two sides of any journal may comprise one or more entries and one or more type of asset, liability, or capital. They don't necessarily need to be an asset and a liability. They could be two assets. But because of the accounting equation, you can't have an imbalance between the two sides, the debits and credits of any journal. So we'll go through some examples of financial transactions and what happens in terms of the journal. So a shareholder starts a business with £30,000 paid into the company bank account. The bank account is increasing, so it's an increasing asset. That's plus money, that's a debit. The shareholder is going to want their money back in the future. That's an increase in shareholder capital, which is an increase in minus money, and that's going to be a credit. So the journal for this transaction, where a shareholder starts a business with £30,000 paid into the company bank account, is going to be debit the bank account, £30,000, and credit the shareholder capital account, £30,000. We now have a situation where the company buys a van for £10,000 paid from the bank. The van's going to be used to create money in the future, or even we could just sell it now. So that's going to be an increasing asset, so that's plus money, and that's going to be a debit. The money is paid from the bank, so that's a reducing asset, so the asset, the money in item, is going down. So that's minus money, and that's a credit. So what we've got here in this journal, we've still got two sides of the journal, and they're only within one type of category, the asset. So you don't have to have an asset and a liability and a capital in each journal. You can have two assets in this situation. The journal is debit van, an asset, £10,000, and credit the bank, £10,000. Let's do the next example. The company makes sales of £20,000 to a customer on credit, and so here we've got to introduce the concept of sales. The customer will pay the money later, so they've done it on credit. So this is what the term is, on credit. I've not paid for it now as the customer. The customer will pay the money in later. That's increasing money in later, so it will receive later, so plus money, and that's a debit. The shareholder is going to want that money. That's what sales represents. Sales represents money that's going to go out to the shareholder at some point in the future. Purchases represent an expense, money that won't be going out to the shareholder in future. So the shareholder will want that profit later. That's going to be an increase in the money out item in there. There's an increase in the money out item, which is a credit. So an increase in minus money, which is a credit. The journal is therefore debit trade receivables, debtors. Sometimes the word trade receivables could be trade debtors, could be debtors, 20,000, and credit sales, 20,000. The total of our debits and credits for all of those transactions was 60,000 of debits and 60,000 of credits. So we can see that no matter how many journals we put in, we're always going to have this situation at the end where our debits are equal to our credits. And that's how we produce journals. Consider whether it's a money in item or a money out item. Consider the direction of travel of those money in and money out items, and then produce your debits and credits and check that your journal balances at the end.